Welcome to this explainer. Today, we're diving into what has been an absolutely chaotic week for Tesla as of August 6th, 2026. We are looking at a really fascinating collision right now. On one hand, you've got Tesla's massive, literal world-changing AI ambitions, but on the other, some incredibly harsh financial and regulatory realities. If you follow this company, you know they don't do anything in half measures. But right now, the gap between their futuristic promises and their present-day challenges is honestly wider than ever. So let's make sense of it all.
Here's our quick roadmap for making sense of this whirlwind week. We're going to start with a massive $16.8 billion AI bet, then tackle the rumors versus reality in China, look at how all this ambition is actually hitting the balance sheet, check out the new Model Y, L, and Megapack hardware, and finally, end with a looming regulatory safety probe that you definitely need to know about.
All right, let's jump right into part one, the $16.8 billion AI bet. Okay, so let's talk about this massive announcement regarding SpaceX and Tesla's joint AI semiconductor complex down in Grimes County, Texas. They're calling it Terafab, and it's already shaking up the tech world. To kick things off, they are pouring a staggering $16.8 billion in initial investment into this project. The goal here is complete vertical integration. We're talking designing, packaging, and testing advanced logic and memory chips entirely under one roof. By bringing this cutting-edge manufacturing in-house, they're attempting to lock down the single most critical component of their entire future roadmap, which is, of course, raw computing power. To really wrap your head around the sheer scale of this thing, consider this. The facility is going to span 100 million square feet. That is a massive footprint, and it's expected to create at least 3,000 high-paying jobs in the state. Texas Governor Greg Abbott even chimed in, noting that Texas is where big ideas grow even bigger, and honestly, Terafab is the physical embodiment of exactly that mindset. But you have to ask, why do they need a facility this gigantic? Well, it all comes down to their ultimate target. The goal is to generate over 1 terawatt of computing power. They are urgently trying to close a massive global chip supply gap because they desperately need this processing power. We're talking power for Optimus robots, autonomous cybercabs, and even SpaceX's space-based data centers. And here's the kicker. While $16.8 billion is just the starting line, filings actually show total project investments could potentially skyrocket to $119 billion if all the extra phases are completed. It's a bet on the future of AI that is almost hard to comprehend.
Moving right along to Section 2, China, the rumors, and the reality.
So while they're literally building the future in Texas, their operations in Shanghai generated intense speculation and some massive headlines this past week. And what's really interesting here is the stark contrast between media reports and the company's actual response. The Wall Street Journal reported that Tesla was exploring a sale or a spin-off of its China business, allegedly to protect U.S. defense contracts if a SpaceX merger happened. But Elon Musk's denial was absolute and swift. He called it absurdly fake news, while Tesla China officially completely dismissed it as false information that was, quote, never even discussed.
Cutting through all that noise, let's look at the on-the-ground reality. The Shanghai Gigafactory, which, remember, Tesla owns outright, unlike a lot of Western automakers in the region, is an absolute powerhouse. In July alone, they delivered a record-breaking 93,000 vehicles. It is their highest output factory in the world, and it functions as a supercritical shipping hub for Europe, Canada, and the Asia-Pacific region. And this perfectly highlights why the region is so vital for them. China-made EV sales were up nearly 38% from a year earlier. That is their 9th straight month of growth. When you consider that China accounted for about 18% of their total global sales in the first half of 2026, you realize that spinning off this asset would essentially mean severing the very engine that drives a massive chunk of their global deliveries. But how do these massive global ambitions, from that 100 million square foot Texas chip factory to record-breaking output in Shanghai, actually impact the present-day bottom line?
That brings us to Section 3, Ambition Meets the Balance Sheet.
Let's take a closer look at those second quarter financials. At first glance, things look incredibly strong. They hit a record 480,126 quarterly vehicle deliveries. That kind of output successfully pushed total revenue up 26% year over year to a massive $28.24 billion. Automotive revenue specifically climbed 23%. So the top-line growth, it is absolutely there.
But, and this is a big but, the crucial point is what happens further down the balance sheet. Operating income absolutely plummeted. It dropped a staggering 57%, down to just $398 million. This severely squeezed their operating margin to a tiny 1.4%.
On top of that, overall net income dropped 5% to $1.11 billion, leaving them with an adjusted earnings per share of just 33 cents. That fell well below what analysts were expecting.
So what's causing this financial whiplash? Well, quite simply, it's the cost of the future. They saw a 49% surge in R&D spending, hitting $2.37 billion for the quarter, and that resulted in a negative $1.1 billion free cash flow. In plain terms, Tesla's massive build-out is currently burning more cash than the business is bringing in, but they aren't backing down at all. The company is stubbornly reaffirming its plan to spend over $25 billion on capital projects in 2026 alone, just to fund robotaxis, AI infrastructure, and Optimus production.
Let's pivot to Section 4, the Model Y, L, and Megapack. Because despite that intense financial squeeze and this huge focus on AI, Tesla is still pushing hard to get tangible new physical products out to the market right now. First up, we've got the stretched Model Y L. This was previously exclusive to the Chinese market, but it's officially making its US debut. It was actually recently filmed at Tesla's diner near LA, and it'll be built in Austin. Instead of that cramped 7-seat layout, they're offering a stretched 6-seat interior with second-row captain's chairs. It's got an expected range of over 325 miles and a projected price tag of around $53,990. They're aiming this squarely at American families who want a bit more premium space but don't quite want to step all the way up to a Model X. Over on the energy storage side, the news is moving just as fast. The new megafactory in Brookshire, Texas, went from literal dirt groundbreaking to officially producing the new Megapack 3 in just 16 months. That is incredibly fast. This facility is designed to pump out a massive 50 gigawatt-hours of annual production capacity, which scales up their energy storage business at breakneck speed. And this brilliantly illustrates their relentless drive for iteration. When you compare the previous generation to this new Megapack 3, the new unit holds 5 megawatt-hours. That's 28% more energy packed into the exact same physical footprint. Plus, they can now be bundled into what Tesla is calling megablocks. These are integrated units that actually reduce installation time by 23%. And this efficiency isn't just theory. It has already helped them lock down a massive $5 billion deal in Europe.
Now for our final section, Part 5, the NHTSA Safety Probe.
As much as we love talking about AI chip factories and massive energy deals, we really have to ground all this lofty hype with a major regulatory reality check that hit the company this week. The NHTSA, the National Highway Traffic Safety Administration, has officially opened a preliminary investigation affecting a huge pool of roughly 1.2 million vehicles. Specifically, they're looking at 2018 through 2020 Model 3s and 2021 through 2023 Model Ys. The agency launched this probe after getting 156 complaints about sudden suspension failure. The issue is a front lower lateral link detachment, which can potentially cause a total loss of steering control.
What makes this investigation particularly severe is that most of the complaints say this detachment happens with absolutely zero advance warning. It just goes, leaving the car completely undrivable and requiring a tow. Now, Tesla has dealt with similar things before. They recalled about 2,800 cars back in 2021 and another 422 in 2023. But this new probe suggests the problem is significantly broader. If the NHTSA finds a safety-related defect here, it could lead to a massive, highly costly forced recall for over 1 million vehicles.
So as we wrap up this explainer, we're really looking at a company at a crossroads. On one hand, we've got record deliveries, 9 straight months of growth in China, and those massive landscape-altering AI investments. But on the other hand, you have to weigh that against cratering profit margins, massive cash burn, and a very serious safety probe. We have to ask, will this multi-billion-dollar, $25 billion a year bet on the future of autonomy and robotics actually pay off? Or will the crushing present-day financial and regulatory realities drag the company down before they even reach the finish line? It is a truly fascinating time to watch this company. Let me know what you think, and I hope this explainer helped you grasp exactly where things stand right now.